Hey, good morning, everyone. Marty Mazzora here, December 16th, 2019. In this morning's video, I'm going to take you through general conditions, our assessment of where we sit currently, the prospects going forward, the things that lie below the surface, and so on. This is part one of a two-part presentation. My next presentation is going to get into the weeds of our new core allocation and hedging strategy going forward. But I'm going to set the stage first by, again, sharing with you how we see the world as we sit here today. Okay, so in front of you is the simple graph of our PWA index. We were crazy bullish back here in early 2018, but in that beginning of the year letter, I did say that there's one big caveat, and that it would be, the trade war, and if that heats up, we think that conditions will deteriorate ultimately to the point where we have to start getting defensive, and that happened this summer. We actually were in the red below this zero line. We went in the green a little bit, kind of touched it there, and we've been in the red ever since. I think we've had 8 or 9 weeks now. The score today is negative 5.75. Now I want to highlight for you some of the components, just a few of them, the bad, so to speak, and the good. So bad stuff or bad looking stuff. Let's start with the big one, the Institute for Supply Management surveys. Purchasing managers throughout the manufacturing industry in the US and throughout services, manufacturers basically are in recession mode. Below 50 means that they are contracting, and that's what the answer of the survey question suggests. In services, we remain in expansion mode. Of course, we are a service-oriented economy, so that's a good thing. You can see we had a big plunge, came back up, came back down a little bit this last month. Take a look historically at how things look during recessions and how things trend into recessions. So this clearly is not a good look. Coming into the last recession, coming into the one before that, before we had the services sector survey, how manufacturing looked in the recession prior to that one. Now, we also can see here that during this expansion twice, and let's say once during the previous expansion, twice, 2, 3, 4 times before, the manufacturing survey dipped into contraction mode. We actually had what economists call an industrial recession back here in 2015 and 16. But the rest of the economy did not follow. And folks, when we backtest our index, of course, we were assessing conditions back then, just not formally with an index. But our view then was that that was volatility to ignore and that the market would come back, and it did. When we backtested it, our index was green here, which said ignore it, and the market came back, and it did. Like last year when we had that 19.9% correction in the fall, conditions were green, so we said it's volatility to ignore, that the market would come back, and it did. Well, folks, conditions are red, and now we have upside volatility, and I'll put that into further perspective here in a few minutes. Okay, within the Institute for Supply Management manufacturing survey, new orders are at an expansion low. The components, all of them on a year-over-year basis, this was the most recent survey, all of them except for customer inventories were down. That is a very bad look about the conditions in the manufacturing sector. Month over month, we did have 4 that improved, so that's something to pay attention to. We'll watch to see if a new trend develops. But right now, the year-over-year trend looks not good in terms of economic prospects for next year. U.S. industrial production, this is a look that's even worse than the look coming into these past recessions. Durable goods orders had a nice little uptick here this last month. Trend is still lower. Durable goods transportation trending lower. Carloads and intermodal rail traffic 2-year chart, not a good look whatsoever for the U.S. economy. Freight overall, CAS is the benchmarker for freight data, freight shipments. Of course, this would be air, train, truck, water, you name it. Rolling over like it does, rolling over in expenditures like it does, going into past recessions. I like the economist for Cass. I think he's very pragmatic. He was bullish right up till here. Now he believes that we're already in recession. We're not, and I don't think we're going to look back and say that we were. That's his view based on what he looks at in his industry, and he claims that it is the best indicator of coming recession, so he's bearish at the moment. the leading economic indicators to coincident economic indicators ratio. When this rolls over, bad things tend to happen. Typically, this is a good recession signal. Now, it rolls over early and it just tells you to prepare, but we did have a false signal here in the 90s before it finally rolled over. Not so during the other 3 or 4 recessions, and this is the third one here. So we shall see. Right now, this would tell you, get defensive. Chicago Fed National Activity Index, kind of their own macro index, as you can see, very much in the negative, below zero. We want to look at the trend, and this was the trend going into past recessions. This is the trend we're dealing with now. We did have that trend going here into 15 and 16. We did have it coming down here in 2011-12, so it doesn't mean it's going to morph into a red shaded area on my chart. It just means the conditions are worsening. Capacity utilization. To what degree are factories running near full capacity? Well, 76, you can see it's plunging. It was plunging here again, 2014 or 15 and 16. This is how it looks going into recessions. A really bad look. But again, nothing says that we can't turn the corner once again and move higher. But right here, a back test of our index was green. Right here, it's red. Good stuff or goodish stuff. Consumer. Brick and mortar retail, you can see higher lows. I like that. We do have lower highs. We got to keep our eye on that. Online retail, which no doubt is affecting brick and mortar as well, looking very good. This is how brick and mortar looked going into the last recession, ironically, kind of like it does today. Here it was just completely rolling over before the tech bubble burst. U.S. auto sales looking okay, not looking robust, but hanging in there. This could be a continuation pattern. We could see them break out to the upside. You can see how they were rolling over going into the last 3 recessions. Consumer spending, a higher low there, higher high. Need to see a little more pickup there. The 10-month moving average not looking too inspiring. We try to smooth out the numbers a bit. You can see how they looked coming into the last recession. This doesn't look recessionary to me right now. Consumer confidence, a bit of rolling over here in the Conference Board survey. University of Michigan, still lower highs, although we had a really good print here this last month. Weekly Bloomberg Comfort Index, still trending higher. This is how they looked going into the last recession. This is how they looked going into the 2 previous. So right here, this looks okay. Obviously a bit concerning with the upper 2. U.S. housing starts, doing really well here of late, as you can see. Of course, this was a housing and mortgage bubble, so that was a look as we were rolling over there. Past 2 recessions doesn't look like the past 3 recessions. Housing permits really picking up this morning, by the way. News has it that home builder confidence is at like a 20-year high or something like that. So home builders are very optimistic with lower interest rates and maybe a pickup in the economy is obviously what they're thinking going into next year. Okay, so under the surface stuff, beyond our index, and there's a ton of it, so I'm just highlighting some of it here. Just saying, right? The longest bull market in history. Bull markets never, ever have and never will last forever. So we're pushing the limits on the calendar or time-wise, and I don't think they die of old age. I think they die of excesses and stresses, and that's what we're going to look at next. Okay, so profit margins for the S&P 500. Pardon the busyness of the chart, but let's just focus on the red line. Here it is rolling over back in 1998. We had a 22% dip in stocks on an intraday basis. On a closing basis, just under 20%. Rolled over here when the tech bubble burst, big bear market, call it 51% decline. Started to flatten out, market held in there, picked up steam again, profit margins, rolling over during the Great Recession, 58% decline. Rebounded out of that nicely, began to roll over here in 2011, European debt crisis and so forth was the catalyst here, but profit margins were waning, 21% decline. Really rolled over here, call it a 16% decline. Threatened to here, got some volatility, got some big volatility here in the last quarter of last year. Rolling over, market still trending higher. One of these is going to have to catch to the other one. Doesn't look good right now, folks. Earnings per share, the green line. Earnings per share rolling over, tech bubble, 51% decline, flattening out here, that 22% decline. Nothing happening here as they began to flatten. Big things happening here as they rolled over. Market held in there during this flattening, rolled over, nice correction, straight up to the moon, right in here. Had a little, twist and turn, 20% dip last quarter. Concerning look right here. EPS rolling over while the market continues to go higher. Not a great look. S&P 500 price. S&P 500 companies profits. This is too wide a gap for comfort, believe me. Here was the gap heading into the tech bubble bursting. Here's the gap leading into the credit bubble bursting. Here's the gap now. It was rolling over here, saw some stress. Tax cuts, 2017, right to the bottom line, kind of flattening, a little bit of a rolling over, a little bit of an uptick here. Okay, so what's fueling that earnings per share drive, right? Is it, profits going up? Well, we know it's not, based on the chart I just showed you. What it's been and what it continues to be, folks, is corporate share buybacks. That monster asymmetric move that I just showed you in the green line and earnings per share. This is what it's all about. It is not about U.S. and foreign investors, the green line here, buying. And it's not about inflow to mutual funds and ETFs. It's about a shrinking of shares outstanding by companies buying back their shares. For example, if you have 1 billion shares outstanding and you make $1 billion in a year, you divide those two and you have $1 per share earnings. If you grab some cash and buy back half your shares, you now have 500 million shares outstanding, but you still make $1 billion. You just doubled your per share earnings, which was the green chart I just showed you. And it had nothing to do with real, organic, healthy growth. It has to do with what's called financial engineering. And folks, that has a huge amount to do with where we find ourselves today. In fact, this is 2018 data, but it's only gotten worse in 2019. Dividends and share buyback in the volume, in the green shaded area. Free cash flow in the blue. They're borrowing big time. They did here right before this big correction, 57% drop. They did right here right before this 51% drop. Obviously, they don't have enough cash to support the level of share buybacks, so they've been borrowing to make up the difference. A little bit on that. Ray Dalio gets credited for making more money for investors than any manager in history. Says that when prices have been driven by leveraging, the market gets fully long and overpriced. It becomes ripe for a reversal. It reflects a general principle. When things are so good that they can't get better, yet everybody believes they will, tops are made. This is me. Leveraged share buybacks are the definition of the first sentence above, and that's borrowing to buy back shares. Investopedia talks about it. In 2008 to 18, companies spent over $5 trillion. I just showed you that chart, buying back their own stock, which was over half their profits. Leveraged buybacks have made a big comeback in the U.S., with share repurchases exceeding free cash flow since 2014. The buyback boom has increased the risk for both bondholders and stockholders. For example, McDonald's, whose executives depend on earnings per share metrics for 80% of their pay, borrowed so heavily the last couple of years that they've gone from an A to a triple B rating. That is crazy. And it's just because they loaded up their balance sheet with debt to buy back shares and make money on their paycheck in the process. S&P 500 is top heavy once again. Top 5 stocks currently are Apple, Microsoft, Google, Facebook, and Amazon. They're 16.5% of the index. Haven't seen that since 1999, and you know what happened after that. Forward price to earnings ratio, 19.3 for the S&P, higher than it was before the last big bursting. Foreign, about the same. Emerging markets look a little cheaper, but not as high as it was in 1999. But stocks look stretched right here based on a forward PE. What about sales? The E in the PE, the earnings can be manipulated. You can move, expenses to other categories, happens all the time. We know on an earnings per share basis, they've been hugely manipulated with share buybacks. Tough to manipulate your sales numbers. So when you look at the price of the S&P relative to actual sales, what's coming in the door, we're as high as we've ever been, folks. This is known as the most expensive stocks ever got on a price to earnings basis. Well, they're there again on a price to cash flow basis, on a price to sales basis. And that is something to worry about. Warren Buffett looks at the total market cap of all stocks in the US relative to GDP. They even call it the Buffett indicator. Here we are today, folks. That's more expensive than I think it's ever been, certainly since 1950. Warren Buffett himself, and a little earlier this year, he did his annual letter to his investors. This is him. Prices are sky high for businesses possessing decent long-term prospects. He has a good track record. Okay, percentage of US IPOs with negative earnings per share coming out of the gates. Rivals, 1999. Companies throughout the world with negative free cash flow today. 82% of Canadian companies, 71% of Australian companies, 58% of US companies, and so on. Not a good look, as I'm sure you can tell. Balance sheets of the Bank of Japan, European Central Bank, the Fed, the People's Bank of China, exploding higher. Folks, this is very unusual in an economic expansion. This says something's wrong. Something is very, very wrong in the repo market, the overnight lending market where banks take care of themselves to keep their reserves where they're supposed to be. The Fed from September on has had to pump money in every single night. Now they're printing 60 billion a month, and they're about to throw a ton of cash into the overnight funding environment to stay alive through the end of the year. They have a problem. I have dug quite deep into that problem here the last few days and weeks. We'll no doubt talk more about it here on the blog. Clearly, the Fed is going to print enough money to take care of the problem so money markets don't freeze up like they did back in 2008. But there's a fundamental problem under the surface that has to do with a lot of things. And again, I'll share some detail here when I have a chance. But it's got a lot of people really concerned, believe it or not, for what's going to happen actually right at the end of the year. The Fed knows it's there. They'll print enough, I'm sure, to keep things going into next year. But it's a problem. And it's also helping the stock market. Whenever the Fed starts juicing things or supporting things with new cash, it suppresses interest rates and it forces people further out on the risk curve. And people who probably shouldn't be taking that kind of risk in the market are, and it's just exacerbating some of these things we're talking about. This is the Fed throwing money into that overnight lending market. And here's when they did it during the last recession, or I'm sorry, 2 recessions ago. Here's the last recession. Here's in between. They did so much of it that they didn't need to do much, and then kaboom, record levels right now. This is something to pay attention to. There's something going on in the credit markets on a very short-term basis in the money markets that has got the Fed very concerned and forcing them to just throw cash into it. Okay, debt. U.S. business borrowing eclipses households for the first time since 1991. Triple B corporate debt. This is this year, folks. Remember McDonald's, right? Triple B corporate debt level. The issuance is off the charts. By the way, pensions, for example, trillions of dollars in pensions, can only buy, when they're in the debt market, investment grade debt. You get below triple B, you're into junk debt. Pensions can't hold junk debt. Economy turns, triple Bs get downgraded to double Bs. All hell breaks loose because there is not remotely the liquidity underneath in the junk sector to capture what's going to be hitting it down below. And this is what should be keeping us up at night in terms of the potential depth of the next recession. Debt overall throughout the world. This is 2018 numbers. We'll get 2019 numbers after the year end. Global debt now worse in terms of the imbalance, 269% than all major bubbles in the last 30 years. Lots and lots of borrowing out there. Moody's, I says this week, I think I wrote this in mid-October. I quoted Moody's. Investors have maintained a voracious appetite for high yield debt, fueled by post-financial crisis quantitative easing, which they're doing again now, paving the way for unprecedented weakness in companies' capital structures and erosion of their credit quality. Investors will enter the next downturn more poorly positioned, and I'd like investors to be everybody except for our clients. The percentage of first-time debt issuers rated B3 is about 40% today, twice the last recession, and that was the worst one since the Great Depression. Defaults could, I think, will swell beyond that level. And that's what I'm talking about in terms of the depths of the next recession. The International Monetary Fund, their Global Financial Stability Report, all this easing encouraged more financial risk taking and a further buildup of financial vulnerabilities. And again, it's happening again today in ramped up fashion. Elevated vulnerabilities in the corporate and in the non-bank sectors in several large economies compelled insurance companies, pension funds, and other institutional investors to invest in riskier and less liquid assets. Again, what compelled it was all this easy monetary policy and these low rates, so they have to capture some yield, which facilitated obviously a big rise in corporate debt burdens. Share of debt owned by firms with weak repayment capacity is already sizable in several major economies and could, I would say, will reach global financial crisis levels as 2008 in the event of an economic downturn. The search for yield in a low interest rate environment has led to stretched valuations in risky asset markets around the globe. Sharp sudden adjustments will happen because of that. Such sharp tightening could have significant macroeconomic implications, especially in countries like the US right now with elevated vulnerabilities. Institutional investors' search for yield could lead to exposures that may amplify shocks during market stress, and so on and so forth, folks. I think you get it. Current and anticipated monetary policy has substantially boosted risk assets. Normalization of rates and balance sheets will be very, very difficult. In fact, last fourth quarter of last year, that 20% decline proved to Jerome Powell that he can't do it, at least not right now. CEO and consumer confidence on a chart. CEOs, and this is the latest survey, are more bearish than they typically are outside of recessions. Consumers always hold in there right up to the end. So you see it here. The CEO rolls over. Why does the consumer ultimately roll over? Well, because the CEO has to accommodate for the things that make him and her pessimistic. Ultimately, when jobs go, the consumer goes, and then the economy goes. CEO sentiment, 4-month lag, typically relative to the S&P 500. Man, did it roll over here. This chart suggests that the S&P will ultimately follow, unless, of course, maybe the trade war, the mini deal that we just got, other things, Brexit perhaps, may push that sentiment, and maybe CEO confidence catches up to the market, and the market doesn't roll over. Very possible. CEO departures in August, more than ever. That's a record. Around that time, CEOs departing this year was more than CEOs for that time of year in 2008. Well, 2008 makes sense, right? Does it make sense now if we're in this great, wonderful, robust expansion? No. Why would it make sense? Well, it makes sense because they levered up their balance sheets. They pushed EPS, earnings per share, as high as they possibly can. And they realize, and of course the sentiment surveys would tell you they realize the conditions aren't good, and maybe we get out while the getting's good. Payroll growth versus earnings growth. We are seeing a pickup in earnings that you'd think is a good thing, but it's also a late cycle thing. See what happens here. Payroll growth on a year-over-year basis slowing down, earnings picking up, tends to be late cycle. Look how that looked going into the last multiple recessions. So that basically is just confirmation that we're in late cycle. Wage growth continues to eat into profits. Here are U.S. corporate profits. I showed you profit margins declining. Here are wages going up. If you can't find some profitability and the tight labor market keeps wages rising, this tends to be the ultimate outcome, and that is recession every time, virtually. Okay, our index back tested. Here we were rolling into the red for several weeks. We had about 4 or 5 weeks back in the green in a small way, and then here we are back in the red, still in a small way. I mean, this could resolve higher, no ifs, ands, or buts about it. Historically, when we rolled over back in here, all this fear, among policymakers and all that stimulus that stock markets love, it's loving it this morning as I talk, pushes the market higher. In fact, when our index rolled over back here, the market staged another 17% rally before it declined by 51%, ultimately taking out 3 years of gains. Of course, while this had to be very, very frustrating if indeed we got defensive here, or if we did, we didn't. We were rotating out of tech. We did the best we could. We caught more of this than I like to admit. Clients did okay. We came out of it. We bought on the way down, but we don't want to play that game that way this time. Here we are before the last one. Our index rolled over. Market rallied 15% before it gave up 57% and 11 years of gains. Folks, this is what we're seeing here now. Again, that time we got out of REITs and anything associated with mortgages way early back here in 2006. Felt like an idiot as REITs continued to go. Of course, was really glad we did here, but we stayed too much in stocks and we caught too much of this decline. Not nearly all of it. And of course, we did buy on the way down and certainly a bunch at the bottom. So we came out of it very nicely. We don't want to play it that way again this year. If we've done the work, we have the assessment, we have a lot of history, we want to get defensive and capture much, much less of the next bear market than we did the prior two. But it does require that we get defensive when conditions say get defensive, and we allow the market to run up to some degree without us. But that's what we have to do, folks, because as you can see here, in a very short period of time, the market can wipe out a very long period of gains, and we want to be ahead of that if at all possible. Okay, so folks, that's the presentation for this morning. So again, that could be a several-hour presentation, believe me, to give you all of the data that we're looking at. Some of it actually is good. Some of it is actually improving. The next video that I'm going to put together very shortly is going to explain to you the changes that we're going to make to your portfolio, how we're going to hedge. It's going to be different than we did last time. We'll have more opportunity to capture upside than we have the last few months. We're going to introduce other asset classes that we haven't needed to own up to this point. And frankly, I'm looking forward to next year. Thank you for watching and listening. And I'll be back with details as to how your portfolio is going to look very, very soon.